So imagine an autonomous AI agent deciding it. It needs real-time satellite weather data to optimize some global logistics route.
Right.
It doesn't ping a human for a corporate credit card. It doesn't, fill out a subscription form. It just independently executes this microscopic financial transaction using digital cash.
Unlocking the firewall instantly.
Exactly. And it just scrapes the data it needs. And the crazy thing is that machine-to-machine economy, it isn't some science fiction concept to look forward to anymore. It was like quietly deployed into the internet's architecture literally this week.
Yeah, it's wild. It's actually happening right now.
It really is. So welcome to a new deep dive on the week that was. If you, the listener, have been wondering why market prices are just thrashing wildly while the underlying adoption seems to be accelerating, well, you are in the right place.
We've got a lot of ground to cover.
We really do. We are cutting through the daily noise to analyze this massive structural tug-of-war playing out across a stack of recent filings and operational reports. Basically, we're watching short-term macroeconomic capital flight actively battle against this long-term structural institutional adoption.
Yeah, and the friction between those two forces, it's creating incredibly violent price action. You have this entirely new financial plumbing system being installed globally, right? But the macro environment dictating the daily liquidity is just highly, highly constrained.
Right, which makes it super confusing if you're just looking at the surface level.
Exactly. We really have to look at the mechanical realities of both sides to understand, the current valuation models.
So let's start with that immediate macroeconomic squeeze, because, man, we just witnessed severe V-shaped roller coaster in the spot market.
We really did. It was textbook whiplash.
Yeah. And on the surface, the domestic data looked like absolute rocket fuel for risk on assets. We saw cooler than expected U.S. inflation numbers. Headline CPI dropped to 3.5%.
Which is huge. And core CPI cooled to 2.6%.
Right. And the wholesale producer price index, the PPI, actually contracted by 0.3%.
Which normally that kind of data signals a massive green light for institutional allocators.
Yeah, it's supposed to be the all clear, right?
Exactly. It implies the central bank might finally loosen monetary conditions. And historically, that sends capital rushing out of safe havens and, pouring into high-growth, volatile assets. And initially, the market reacted exactly according to that script.
Yeah, the spot price just ripped past $64,000 almost immediately.
But it didn't last.
No, not at all. That momentum was instantly crushed by this wave of global contagion originating out in Asia. It was this localized credit crisis in South Korea that hit major conglomerates like Samsung and SK Hynix.
And this is where the actual mechanics of global markets get so brutal.
Yeah, tell me about it. That localized credit freeze triggered this absolute avalanche of 1.2 million forced liquidations on the Upbit exchange.
It's staggering. 1 million plus liquidations.
Over-leveraged traders were facing margin calls in their traditional portfolios, so their digital asset collateral just got automatically sold off by the exchange's risk engines.
Right, because it acts as a wrecking ball through the global order books. An automated liquidation engine, it doesn't care about positive U.S. inflation data.
It doesn't read the news.
Exactly. It just executes market sell orders until that margin deficit is cleared. And this was really compounded by a severe hollowing out of the market's underlying liquidity.
Stablecoin drain.
Yeah. The total global stablecoin supply plummeted by $10 billion recently. You had Tether losing $6 billion in capitalization and Circle losing $7 billion.
It's just wild. I like to think of stablecoins as like the transmission fluid in the global trading engine.
That's a great way to look at it.
Right, because they're the primary, quote, currency for nearly every digital asset trading pair on the planet. So when you drain $10 billion of that fluid out of the system, the gears just start grinding.
You lose your shock absorbers.
Exactly. It's like trying to fill a swimming pool while the drain is wide open. The positive inflation data is the water going in, but these global liquidity crunches and stablecoin contractions, that's the open drain. A large sell order that normally would be absorbed by deep stablecoin bids suddenly causes massive price slippage.
Because the bid depth simply isn't there anymore, which completely explains the structural weakness we are seeing right now. Like you said, when the transmission fluid runs low, the engine is going to seize up no matter how hard you rev it with positive inflation data.
So what are the models saying about this?
Well, analysts at NYDIG have modeled this exact supply-side overhang. They point out that the current market structure is really beginning to mirror the cyclical drawdowns we saw in 2014, 2018, and 2022.
Oh, wow. So they're looking at historical parallels.
Yeah, because of this evaporated bid depth and the aggressive supply hitting the market, they're actually projecting a potential supply-driven cyclical low of maybe $38,000 to $39,000 later in this cycle.
Man, that's a significant drop. But I guess that projection assumes the macroeconomic environment continues to act as an anchor.
Which it very likely will.
Right, which brings us to Federal Reserve Chair Kevin Warsh. His recent congressional testimony made it abundantly clear that the Fed has this absolute intolerance for elevated inflation.
The messaging remains aggressively hawkish.
Yeah, they are not backing down. High interest rates are going to continue to act as a gravity well on zero-yield assets 24/7.
The opportunity cost is just simply too high. I mean, think about it. If an institutional treasury manager can park capital in short-term government paper and earn a risk-free yield, they need an overwhelming growth catalyst to justify holding a volatile, non-yielding digital asset instead.
Yeah, why take the risk if you don't have to?
Exactly. Until that risk-free rate drops, that gravity well will just continue to pull capital away from the speculative edges of the market.
Okay, so the macro picture is highly restrictive. But while that's happening, sovereign governments and regulators are clearly anticipating a massive regime change because they are aggressively maneuvering behind the scenes.
The contrast is fascinating.
It really is. Just look at Japan. They just passed landmark legislation reclassifying Bitcoin as a recognized financial asset, basically standardizing its treatment with traditional equities.
And the implications for corporate balance sheets in Japan there are just enormous.
How did it work before this change?
Well, previously, holding digital assets subjected Japanese companies to these really punitive mark-to-market tax rules. They basically had to pay taxes on unrealized paper gains at the end of every single fiscal year.
Oh, that's brutal. So you haven't even sold the asset, but you owe taxes on the gains.
Exactly. It made corporate adoption mathematically toxic. You just couldn't do it.
Yeah.
But by standardizing it with traditional equities, Japan just unlocked the ability for corporate treasuries to actually hold the asset without completely destroying their cash flow.
That is a massive fundamental shift. And meanwhile, the US and the UK just issued joint task force recommendations to standardize stablecoin insolvency frameworks.
Yet they're specifically prioritizing token holders over other general creditors.
Right. They are building the legal scaffolding required for massive commercial banks to finally enter the space because, the regulators know that no Tier 1 bank is going to interact with a stablecoin if a bankruptcy means the bank is treated as an unsecured creditor.
Right. Waiting in line for pennies on the dollar, they just wouldn't touch it.
Exactly. But wait, I'm having a hard time squaring all this forward-looking regulatory work with what the U.S. government is actually doing with its own holdings right now.
You talking about the transfers?
Yeah. We saw the government move $297 million in seized crypto, this is from historical forfeiture cases, directly to Coinbase Prime. Moving hundreds of millions of dollars to an exchange, that looks exactly like preparations for a massive market dump.
It definitely looks scary on the surface.
Right. Didn't President Trump recently mandate a strategic Bitcoin reserve that requires federal agencies to hold on to seized Bitcoin? Are we sure the government isn't quietly front-running a policy change, like selling off these assets before they are legally mandated to hold them?
It's a really valid question, but looking at the specific entity receiving the funds changes that calculus entirely.
Okay, how so?
Well, Coinbase Prime is not a retail trading platform. It operates as an administrative custodian for state-level actors and massive, massive institutions. The U.S. Marshal Service actually requires these institutional vaults to securely manage the sheer volume and, the cryptographic complexity of seized assets.
Okay, so it's more about secure storage than liquidating.
Exactly. So while a transfer to a normal exchange usually signals incoming sell pressure, a transfer to a prime custody vault is almost always just an internal administrative consolidation. It is highly, highly unlikely to be an open market sale, especially given all that intense political momentum behind holding those reserves.
Okay, so it's an administrative reshuffling, not a liquidation. That makes a lot more sense.
Yeah, it's just infrastructure management.
Mm-hmm.
And, they're responding directly to the structural failures of the past few years.
Speaking of infrastructure, we're seeing similar legal scaffolding being debated domestically too, right? The Clarity Act is attempting to finally draw a hard boundary between digital commodities and digital securities.
Which is desperately needed. And on top of that, you have the NCUA's new Genius Act regulations. They're establishing actual risk and capital standards for credit unions that want to issue stablecoins, basically bringing their regulatory requirements in line with commercial banks.
So while regulators and sovereign actors are debating custody and insolvency frameworks in committee, traditional finance giants are simply ripping out the old plumbing and installing their own.
They are not waiting around.
No, they are not. The scale of capital moving into the back-end infrastructure is staggering. Like, Citadel Securities didn't just casually participate in a funding round. They executed a $400 million equity investment into Crypto.com.
And that wasn't just for a stake in the company.
No. It was to embed their traditional market-making algorithms directly into the exchange's matching engine.
Yeah, because you don't make a $400 million infrastructure play to cater to retail day traders. Citadel is upgrading the execution mechanics to handle institutional-sized block trades.
What does that actually look like under the hood?
Well, when you embed Tier 1 algorithms into a matching engine, you drastically reduce latency.
Right.
You tighten the bid-ask spreads to fractions of a cent, and you internalize massive order flow without causing the price slippage we were just talking about earlier.
Wow. So they are basically building the capacity for Wall Street to trade these assets at Wall Street scale.
Precisely. And it's not just Citadel. The Depository Trust and Clearing Corporation, the DTCC, which fundamentally settles the traditional U.S. equities market, they're making an even more aggressive structural move.
Oh, yeah, I saw this in the reports. They executed live production trades using tokenized assets on the Canton network.
Live production trades, not a test environment.
Right, and they handled actual U.S. Treasury delivery versus payment settlement using digital tokens.
Which is massive. The mechanism of delivery versus payment, or DVP, that is the holy grail of financial settlement.
Break that down for us. Why is DVP so important?
So in the traditional system, settling a U.S. Treasury bond involves multiple clearing houses, messaging systems, and usually a T+1 delay. There is always this window of time where one party has sent the money but hasn't received the bond yet.
Right, creating counterparty risk.
Exactly. Someone could go bankrupt in that window. But by tokenizing the Treasury on the Canton network, the DTCC turns it into a digital bearer instrument. The payment and the asset swap simultaneously, atomically, in a single transaction.
So the counterparty risk drops to zero.
Zero. And it completely bypasses the legacy settlement delays.
That is just incredible. And we're also seeing this automation hit the wealth management sector. Major registered investment advisors firms like CapTrust, which manages over $1 trillion, and LPL Financial, they are hardwiring Bitcoin ETFs into their centralized model portfolios for their ultra-high net worth clients.
Which fundamentally changes the market structure.
Yeah.
The transition from discretionary trading to systematic allocation is a massive pivot.
Because it takes the human emotion out of it.
Exactly. When an asset is approved in a centralized model portfolio, the capital flow becomes programmatic. Every single time a client deposits new funds or a portfolio rebalances at the end of the quarter, the system automatically bids on the ETF.
So it creates a robotic, continuous baseline of demand.
Demand that does not care about daily headlines or macro noise. It just buys.
That concept of programmatic automated capital, it brings us to the most fascinating micro detail in this week's reports. This is the Cloudflare by 402 protocol deployment I mentioned at the very top of the deep dive.
Oh, this is such a game changer.
It really is. Cloudflare essentially built a system that allows autonomous AI agents to pay API access fees using USDC stablecoins via HTTP 402 codes.
It basically acts as a digital programmable toll booth built specifically for the machine-to-machine economy.
A digital toll booth, exactly. So if an AI model needs to pull data from a proprietary research database, it hits this by 402 gateway. Under the legacy web architecture, an AI hits a paywall and just fails.
Right, because you need a human to physically type in a 16-digit credit card number, pass a fraud check, and establish a recurring subscription.
The machine can't do that. But now, the AI can independently execute a microtransaction in USDC instantly and cryptographically to gain access.
It eliminates spam, it allows creators to monetize data in real time, and it entirely removes human latency from the payment loop.
Which completely destroys the outdated narrative that digital assets are just, speculative casino chips.
Totally. It proves that stablecoins and programmable money are rapidly becoming the utility layer for the internet itself. And you see this back-end integration happening simultaneously across traditional payments networks, too.
Yeah, Visa just launched a platform providing a fully audited, compliant environment for traditional banks to mint and route their own stablecoins.
They're literally handing financial institutions the software developer kit to build on blockchain rails without having to understand the underlying cryptography.
They're abstracting away all the hard stuff.
Exactly. And look at the Merrick Group, which is this massive global financial services platform. They just began accepting USDC as collateral for initial margin on derivatives trades.
That solves a huge friction point,
It's
right?
huge. In traditional global finance, if a hedge fund in London needs to post margin for a trade in New York, they face cross-border settlement latency, foreign exchange friction, and banking cutoff times.
The bank is closed on the weekend.
Right. But by accepting USDC, Merrick's allows that hedge fund to post margin globally in seconds, 24/7. The end user doesn't care about hashes or block times. They just care that their capital efficiency increased and that cross-border drag completely disappeared.
So the entire asset class is pivoting from a front-end speculative toy to invisible back-end settlement plumbing.
Invisible is the key word.
Yeah. But this industrialization isn't confined to just software code or API gateways. It is fundamentally altering physical real estate and energy infrastructure.
The mining pivot.
Yes, the post-halving environment is forcing public Bitcoin mining companies to execute a massive physical pivot.
Because the halving cut the block reward by 50%.
Yeah.
Mining companies that were marginally profitable are now facing brutal margin compression.
The electricity costs remain the exact same, but the revenue generated per terahash has just plummeted.
Which explains why we're seeing companies rapidly abandon the pure mining model entirely.
Like CleanSpark. They just signed a 20-year, $6.6 billion lease to transition its massive Georgia mining campus into an artificial intelligence and high-performance computing data center.
$6.6 billion. That's not a small pivot.
Not at all. And LM Funding is executing the exact same operational pivot, moving their facilities away from cryptographic hashing and toward AI compute infrastructure.
You really have to look at the financial math behind these transitions to understand why they are so incredibly attractive right now. Like, CleanSpark didn't just lease the space, they executed a triple net lease.
Wait, a triple net lease? That structure transfers nearly all the risk to the tenant, doesn't it?
It does. In a triple net lease, the tenant, so in this case the AI company, agrees to pay the base rent plus all the real estate taxes, building insurance, and maintenance operations.
Wow. So CleanSpark isolates itself from the extreme volatility of Bitcoin price swings and mining difficulty adjustments.
Exactly. They secure predictable, multi-billion-dollar cash flows by essentially leveraging their most valuable assets. And here's the secret. Those assets are not the ASIC mining rigs.
It's the secured power contracts and the land rights.
Bingo.
Because traditional AI data centers are currently facing, $24 billion in delays across the U.S. due to aggressive public zoning disputes and power grid limitations.
The AI firms need gigawatts of power yesterday. And the Bitcoin miners are already sitting on operational grid-connected substations.
So they are executing a massive energy arbitrage play. The miners are arbitraging the desperate demand for AI compute power against their deeply entrenched energy infrastructure.
Just brilliant business, honestly.
But wait, doesn't this introduce a massive systemic vulnerability? Like, if the largest industrial miners in North America lease out all of their secured power capacity to AI firms instead of actually mining Bitcoin, what happens to the global hash rate? Does the underlying security of the Bitcoin network collapse if all the industrial miners just become high-tech landlords?
It's a great question. In the immediate short term, yes, it caps the growth of the North American hash rate.
Wow.
Every megawatt of power diverted to an AI data center is a megawatt not securing the Bitcoin ledger.
Right.
However, the protocol is explicitly designed to self-correct through the difficulty adjustment mechanism. If major industrial miners unplug their rigs and leave the network, the computational difficulty of mining a block drops.
Which instantly increases the profit margins for every other miner still operating globally.
Exactly. It creates this beautiful self-healing equilibrium. It also forces geographic decentralization.
Oh, because the miners have to move.
Right. As North American energy gets priced out by AI demand, mining operations will naturally migrate to regions with stranded, ultra-cheap energy that AI data centers just can't utilize.
Because AI requires massive fiber optic bandwidth and close proximity to population centers, whereas a Bitcoin miner only needs a basic internet connection and cheap power.
Exactly. It's a natural separation of industries based on infrastructure needs.
And we are seeing a vicious culling of companies that don't have that underlying physical infrastructure to fall back on.
Hmm.
The firms that try to survive purely on a crypto treasury narrative without an actual operational business are collapsing.
Yeah, the market is punishing them.
Like BNB Plus, they lost 93% of their value and are facing NASDAQ delisting. And Satsuma Technology is facing a proxy vote forced by Pantera Capital to completely liquidate its Bitcoin reserves at a massive loss and delist from the London Stock Exchange.
It proves you cannot just hold a digital asset on a balance sheet and expect it to magically sustain a failing core business.
Right, unless you have the massive scale and the cash flow to weaponize your balance sheet, which brings us to MicroStrategy. They are playing a completely different survival game.
They really are. While the physical infrastructure firms are arbitraging energy, MicroStrategy is playing defense in this high interest rate macro environment.
Yeah, they just added a massive $450 million to their dollar reserves, bringing their total cash position to $3 billion.
So they're holding billions in Bitcoin, but they are aggressively hoarding fiat currency.
Which seems counterintuitive until you look at the debt.
Exactly. Because they have debt obligations to service. They are securing fiat liquidity to ensure they are never, ever forced to liquidate their Bitcoin holdings to cover operational costs or debt covenants during a macro drawdown.
It's fascinating. You are watching two distinct, highly sophisticated corporate treasury strategies play out right now. The miners executing physical infrastructure arbitrage, and the software holding companies accumulating massive cash buffers to defend their capital structure.
Both are adapting to survive this specific macro phase.
So this brings the entire picture into focus for you, the listener. If you pull back from the chaotic daily price action and those liquidation cascades we talked about, the central theme across all these reports is the aggressive structural maturation of digital assets.
The era where market valuations were dictated purely by retail speculation, sentiment, and meme coins, it is rapidly coming to an end.
Yeah, the legacy financial plumbing is being entirely replaced while the water is still running.
That's the perfect way to put it.
Because the dominant forces driving this space forward are no longer retail traders on offshore exchanges. The driving forces are Citadel building institutional matching engines, the DTCC settling U.S. treasuries via tokenization, and multi-billion-dollar AI data centers swallowing up mining infrastructure.
The volatility you see in the spot price today is just surface-level chop on a very deep, structurally sound, institutional ocean.
And that infrastructure maturation is going to create macroeconomic consequences we haven't fully prepared for. Which brings us back to that Cloudflare by 402 protocol and those autonomous AI agents using stablecoins to pay for their own data access.
A programmable toll booth.
Exactly. If autonomous agents are beginning to independently transact using digital borderless cash at a microscopic level, what happens to traditional monetary policy?
It's a massive question. Central banks manage the global money supply by adjusting interest rates to influence human consumer behavior.
Right, human behavior. But how does a central bank curb inflation when a massive growing percentage of daily global transactions are no longer made by humans reacting to borrowing costs, but by machines negotiating with other machines at the speed of light?
A machine doesn't care about the Federal Reserve's target interest rate when it needs to execute a microtransaction to pull an API feed.
It doesn't care at all.
It fundamentally challenges the core mechanisms of our current economic models. How does the global financial system govern a machine-to-machine economy that settles instantly across borders without a traditional bank in the middle?
That's the billion-dollar question. Because based on the infrastructure deployed just this week, that economy has already arrived.
It's here. We're living in it.
It is a profound structural shift, and we will be tracking every single step of it. Thank you for joining us for this deep dive on the week that was. We will catch you next time.